So yeah, hello. I welcome you to today's special webinar here, exclusively for JFD brokers. How to trade the market opening of the US markets. My name is Jens Klatt, and I've been holding this webinar for several times now. And in fact, the strategy we want to look at today won't change or hasn't changed. And what I can add here already is that currently the market conditions are not very favorable for especially breakout traders. And this is an open range breakout setup we will look at here, which has some trouble right now, even though the performance itself is quite okay. So we are not doing really good, but on the other hand, we're not doing really bad here too. But I can already, I will already say it right here, don't expect too much. So and there has been plenty of times during the last days, in fact, and weeks, that probably we won't have a setup here, because I have a filter I use in my trading for this trading approach, which says if the open range is not bigger than 5 points, in case of the S&P here. So looking, by the way, and I have it usually in percentage. That means I take 0.2% from the current equity level, or the index level we are trading at. So 2,500 points, 0.2% is 5 points. And so that way I try to avoid being stopped in a trade with a too tight range and getting stopped out thanks to the market noise, respectively. It's getting not just unattractive, but also expensive here in terms of the spread. So JFD Brokers, for example, is a 100% DMA STP broker. That means they have external liquidity providers, not just in terms of FX trading, but also in terms of CFD trading. So if you're trading CFD with JFD Brokers, you're not trading against JFD in this case, but JFD has external liquidity providers, nevertheless offers a fixed spread here, or those liquidity providers offer a fixed spread. And in case of the S&P, which we will look at here, it's 0.4%. I'm sorry, 0.4 points. And that said, I want to make sure that by using here a range which is bigger or equals, respectively, is bigger than 5 points, that the spread itself doesn't make more than 10% from the trading range. And that's the reason why I have this filter here. And if you now run a backtest here, respectively, I'll copy paste here my trading journal of the last few days, respectively weeks. You will see that there are plenty of days when there weren't any trades at all, and that has to do with the fact that the range was just too tight. So what I want to give to you here is the following. So it's the open range breakout setup, how I trade it, and how we will trade it today too. 1 second, by the way, just have a look here. Okay, that looks good. So this is the setup. And now, last week, you may have seen the recording of this event here, respectively. You may have listened to this event last week here, 1 week ago. I promised that I'll see what I can do here in terms of a PDF document. I had one, or I have one for the German audience here, and it's on the DEX. This is the only, and let's put this in quotation marks, problem. It's not really a problem, since the strategy itself is the same, but you have to make some adaptations here. So I'll uploaded it on my website, and if you want, I can post a link here, but I can also show you how to get there on my website, and it's for free. The only thing you need to do is to register here, and that's it. So it's jk-trading.com, The website is in German, but the document, respectively, also here the online education, trading education course, for example, in English. And I start to translate several parts here of my website from time to time into English here. And if you click here at Ausbildung, it's the same as education. There you have DAX strategy, and there you can download the PDF, but it's on the DAX. So it's the German index. It's not the S&P. While you can adapt here the presented strategy in this document, you can adapt it there to the on the S&P 500 based on what I just presented to you. So I'll give the link here in the chat box probably, and then you can just download it here from the website. And here you can also see that it's not meant to be just a strategy you copy paste and then that's it. But in fact, no sound. Sound is lagging. 1 second. Really? Also see that it's not. No. No. Sound should be fine. Respectively, is fine at and. Okay. So so here, first of all, strategy the link. Okay. Oh, I'm sorry. I just can't post the link here. Okay. Well, fine. Okay. Not necessary then. I just showed to you how to get there here on the website. I'll post it here below the video then in the after this event if you want. So I can post it in the chat box right now. If you want to download it right here, right now, just go to the website here, jk-trading.com/DAX-strategy, and then you get to the site where you can download this PDF here. And as already said, what the setup I present in there is first of all not spectacular at all. But it's something which, and it wasn't even invented. I think the word invention is completely wrong here. So it's, I mean, it was discovered and it was worked out in a depth and detail here from a guy called Toby Crable. By the way, Toby Crable is not someone out there, but what I can show you here, that's, by the way, someone, he also wrote a review of my book, and so I know the guy, and I can tell you that the guy who reviewed Toby Crable here, this is, by the way, Toby Crable. He is a hedge fund manager. This is really nice what he worked out here, and what I know is that he posted a link here which shows the performance of Crable over the last, I don't know, 20 years or something. So it's not based on this strategy alone, but you can see here, it goes back to 1998, and it is an awesome performance. So there are 2 years, 3 years, probably 4 years, where he hasn't closed in the green here. It's a CTA website, so it's Crable Capital Management LLC, and it shows that Crable knows what he's talking about. And so I don't think that his main intention back then was to give everyone a strategy which works, and that's it. But what I really like about Crable is all the work he put in statistics here in the background. And what I do usually is the strategy I present to you here, respectively, in this PDF here for the DAX. The strategy usually is intended to work as a basic strategy, and you have to adapt it to your own personality, to your individuality, even though we know that with certain parameters and with some discretionary input, if you want, you can already get a proven profitable strategy in the basic version here. And in this, where my accent is from, I think it's accent, right? So I'm based in Germany, so I'm not a native speaker or something. I hope it's not too bad, but there were some people in the past who said my English is far better than the English of the average German, which is like so if you go by train here, for example, it's Deutsche Bahn. You can hear people say something like "Thank you for traveling with Deutsche Bahn," so with this accent, and so that's hopefully not the case when I talk to you here. So let's come back to the strategy. So and this basic strategy, it's really cool since it makes it possible to build a trading routine, which is so important. So trading, in fact, is something really abstract. And many of you listening to this webinar right now, and also listening to the recording afterwards, you may have found out over time here that trading, you were under stress. Sometimes you probably sat in front of your screen, you were clicking on your mouse just because you thought, okay, here's the signal, I have to trade it. And then it was a very stressful situation, and you got completely excited, completely nervous. Market ticked up, ticked down, ticked in your favor, it ticked against you, and you were completely under stress. You had 100% emotion here. And in fact, some people really think that this is how professional trading looks like. So if you probably, you may have probably listened or read some input here in the internet, people telling or talking about trading and telling things like, well, it's the most exciting and greatest adventure some can experience here, and it's everyday new situations, and it's really exciting, and that's one of the main reasons many of the people out there who have a 9-to-5 job and probably are not really happy working 9-to-5 here in a boring job here, why they plan to say, hey, I want to be a trader, because this is something which will give me this excitement, and this is something which will make things awesome, if you want. And so in this context here, I just like to say that's not true. That's far away from the truth. So in fact, profitability in trading comes from having a clear trading routine. And by the way, such an open range breakout setup can give you exactly that. It's a basic strategy. And in fact, it's those 3 steps here you're going through every day over and over again. And in fact, what I can tell you right now is what we will do is we will probably give a picture of how is the S&P US equity markets. Let's also have a look probably at the Dow Jones or something. How is the market looking like right now after the Fed yesterday? But in fact, I'm not getting really excited here at all, since I exactly know which steps I have to go through and what has to happen here. And I will formulate a trading setup after 2:15 p.m. GMT. So the first 45 minutes of trading, I will just see how the market develops, and if the trading range, the open range here, which the market is forming there, does not suit my trading setup here, respectively, does not fit my rules I live by, and from which I know they are profitable. If I keep doing this over and over and over again, well, I just won't trade today. So in this case, by the way, that's pure coincidence here, but in the morning, I came across a very, very nice quote here on Twitter, and I just retweeted it. And I think it perfectly tells what trading is, if you want. So it's from Reina Teo here. So by the way, I recommend to follow this guy on Twitter. That's first thing I'd like to say here. And I think it's a great quote. It's just a great quote. A casino doesn't make money by predicting. They manage their risk and let their edge play out, and it's the same for trading. So in fact, what we could do, for example, here around the US market opening is the following, and then here you will already see what I'm talking about. Making money by predicting. We don't make money by predicting. We don't want to, we don't care if the market goes up or down, but in the end, it's the setup we formulate, which shows for a certain period of time having an edge, meaning having an edge does mean or equals to trading with a positive expected value, and that's all we do here. Now let me just give you an idea here of what I'm talking about in terms of the US markets here. Let's have a look at the NASDAQ 100. Just have a look here. So it's the, I think it's this one, right? We can work with this one. Yes. So it's in fact just showing the trading hours between 1:30 p.m. GMT till 8 p.m. GMT. I'm sorry. No, it's right. It's right. 1:30 p.m. Yeah, right. 1:30 p.m. GMT till 8 p.m. GMT. Now several people ask me, hey, what do you think about markets probably topping out here, or the NASDAQ in this case is topping out? So it's the NASDAQ on a daily chart. And then I've seen, for example, several people sending me emails and saying, hey, look at this, please. So what do you think about this? Don't we have a rising wedge here? So market losing momentum on the upside and probably now breaking on the downside rather sooner than later. And let's put this in perspective here with the Fed now. I mean, from a fundamental perspective, I think we definitely have a good reason to believe that. I mean, the Fed yesterday announced that rates are unchanged, so they didn't hike rates, but there's a good chance that we get to see a rate hike here in December. And on top of that, they plan to unwind their balance sheet from October onwards. What we know is that one of the main reasons we've seen this crazy rally here after 2009 happening, I'm sorry, 2008, the financial crisis hitting the markets. This rally here from the end of January 2009 onwards, and starting from somewhere around 1,000 points and now seeing highs around 6,000 points. So just to make sure we understand what happened here. So the market made 500% and more in the last 7-8 years of trading. And it was not because the tech industry was doing so outstandingly well. Okay, well, I mean, that's not really true. Let's look at Apple, for example, doing some great business here and all that stuff. But all in all, we have to agree that the quantitative easing of the Fed played a tremendous role here in this context. So it's definitely true that the Fed played a major role here, pushing markets up that way. And also, for example, pushing yields to extreme lows after cutting rates to nearly 0%, and by still trying to build some pressure on yields here on 10-year Treasury notes, for example, or something. They kept on they kept on buying bonds here, and that way pushed yields even lower than that with their QE program. On the other hand, they not just bought or they did not just manipulate T-note futures or something like that way, and the yields here, but also we're talking about corporate bonds, for example. So there are plenty of companies out there who wouldn't, in a let's call it normal market environment with normal yields, who weren't capable, definitely weren't capable, or who weren't capable of getting money for nearly nothing, for yields being at 1 or 2%. Or look, in this context, look at, for example, Italy right now. It's the same thing with the ECB here in Europe. I mean, they are buying aggressively bonds of countries who have a youth unemployment rate of something like 40%. That's a lost generation. And their 10-year government bonds, Italian government bonds, for example, yielding like 2.5% or something like that. Ridiculous. I mean, this is just that has nothing to do with reality here. If the youth doesn't have a job and there's a lost generation, someone has to somehow pay back the debt, right? And the only thing, for example, Italy is still capable of paying their bills here is because of the ECB manipulating yields here and pushing them nearly to zero, to ridiculously low levels. Same thing true for the corporate sector here, and also for the tax sector in the US, for example. Now that said, I mean, there's a potential fundamental rival. Let's come back to the NASDAQ here, and this rising wedge forming here. That's usually a bearish pattern which could indicate rather sooner than later a pullback here. We can also put on top here, for example, one sec, let's have a look at the current situation in the volatility index, in the VIX. Let's have a look here at Bloomberg. And there we go to search, and there we go to the VIX. So look at these ridiculously low levels of volatility. So what I just presented to you, I mean, they plan the unwind of their balance sheet. They pushed markets to which we haven't seen before. It's all-time highs also in the Nasdaq here. And now people want to tell us that it's there's no need to worry about the Fed unwinding their balance sheet. There's no need to worry if they start to sell those bonds here they have in their balance, that this won't affect the markets. Well, probably some of them might have a good argument, a good point here, and they will just say, hey, yes, why should the market collapse? I mean, if the ECB and the BOJ and the Bank of England and so on, if they keep on buying aggressively bonds here, well, at the end, we are living in a globalized world, and so we don't need to fear a crash here, even if the Fed now starts unwinding their balance sheets, since there are enough central banks out there still buying aggressively bonds. And that's one of the reasons why the market shouldn't expect a big crash to come here. This is true, but now remember what we should expect from the ECB in terms of their tapering in the near term. So I think we should expect the ECB to reduce their bond buying program from January 2018 onwards and keep on reducing it. I mean, they already reduced it, if you remember. I mean, they bought bonds till March 2017 up to 80 billion a month, and then they reduced it from April till December to 60, which is already a taper. No one ever called it a taper, even though it's a taper. They reduced their bond buying program here, and they will they will also reduce their bond buying program again in the, well, probably from January onwards. Let's see what they will deliver in October here on their ECB meeting. Let's see what they deliver in December if they don't come up with something new in October. But all in all, we should expect that rather sooner or later, probably this unwinding of the balance sheet of the Fed, respectively, the ECB, for example, not buying as aggressively bonds as they did. By the way, the BOE declared something similar around 1 week ago. Look at what happened in all pound sterling crosses. That was no coincidence. They just said, well, guys, we don't plan, or we plan to be more restrictive in the near term, and somehow hinting to a rate hike in the near term. So if we take this from a fundamental perspective here and looking at this technical pattern, you will say, well, you know what? Like to probably come down minimum 5% in the near term. And you know what? It's likely. There's a good chance to that, and you have plenty of good reasons to believe that. But, and this is the thing, let's come back here to why I told you all this. Let's have a look here. Again, in trading, we do not predict. So a casino, it sounds a little, trading has a gambling attitude. That's definitely true. But most of the people out there say, well, no, trading is not gambling. I think it's definitely gambling, but not in the usual sense. So we are not playing craps here or blackjack or whatever, but we play with the same mathematical input parameters here, looking at the expected value. And this is exactly what this quote is referring to. So let's have a look here. Let's just see. Yeah, these are the setups, by the way, for the DAX and for the EURUSD from the morning, from the DAX long or short, and here also from the morning meeting. Expected value, yes, exactly. So expected value, what is the expected value? How is it calculated? Well, we have the average winning trade. We multiply it with the hit rate, and then we subtract the average losing trade, multiply it with the loss rate, and at the end, this number has to be bigger than 0, and you have a positive expected value. Oh, I'm sorry, by the way, average losing trade. It's missing here. And let's put it that way. So, and we put it here. So, and you have everything in there already. So you can see here that this is the reason why there's a saying, let winning trades run and cut losing trades short. This formula has it all, since it perfectly shows that if the average winning trade by letting winning trades run increases while cutting losing trades short, and making this second term here smaller, that usually your overall expected value will increase. That's it. So, and that's also one of the reasons why you might have heard that the hit rate, respectively the loss rate, does not play such an important role. In fact, it doesn't. In fact, it doesn't, since now imagine, what does trying or aiming for a big hit rate means? It means nothing more than you try to predict the direction of the market. And this is just not possible in the long term. You just won't somehow probably have a hit rate of 50%. Probably there are traders out there. There are traders out there. I know some of them, and they are very, very good traders. And these guys, they have so much experience trading the markets. They have such a good sense for the market, such a good feeling for the market. Well, sometimes they just seem to know what happens next, and they just capitalize on this knowledge, on this experience. And this is the thing, most of us here in the retail trading industry, well, we just do not have this experience. We do not have this feeling. We do not have this deep understanding of the market structure, which current drivers we find in the market, why the market is doing this or that. We just don't have it. And that's one of the reasons why, for us as retail traders, it's even more important to focus on here the average winning trade, respectively the average losing trade, and try to somehow get a so-called payoff ratio, which is significantly bigger one here. By the way, that's another component you should always look at, the payoff ratio. That's very simple here. It's the average winning trade. You divide it by the average losing trade. So, and the ratio should be definitely bigger than 1. So that means that you're on average making more money than you're making on average when you lose. In fact, it could be possible that you just make, let's say, 90 cents on average while you're losing $1, and you can still be profitable. But it means to have this a formula here, or in this case, the expected value being bigger 0, that means, after commissions, by the way, that means that you have to have a hit rate which is significantly bigger than 1. I'm sorry, I'm not 1, but 50%, so 60%, and it's very, very difficult to get to such a level here, even though there are people out there having such a hit rate. But at the end, aim for making your average winning trades big and try to reduce your average losing trades. That's all what it comes down to. And now let's come to the point here again, to this great quote. So when it's not about predicting, it's obviously to somehow let winning trades run and let losing trades, cut losing trades short. And on top of that, trading profitability in trading also comes from trading a system which has a positive expected value. This is what you have to look for. And here the cycle closes, since what's the main reason? It's the main reason to build confidence here in your trading, and to know you're trading with an approach which has all this, even though the strategy, for example, you can download here does not necessarily mean that it fits your personality or fits your personal trading style. Some of you might say, hey, great, it's a strategy for the DAX, but I'm more interested, for example, in trading the S&P. These input parameters, you adapt the strategy, and I can also show you some charts a little later, which will show you that this setup here proved its profitability here over a time span of 7 to 8 years now, and it's likely to continue. But there are also people out there who might say, hey, you know what, I'm more an FX trader. The great thing about this strategy is you can also use this strategy, for example, trading the FX markets based on the so-called Asia range. It's probably something we can also have a look at a little later on in this series here, and then we'll just look at, for example, EURUSD or GBP USD, dollar Japanese yen, and all this stuff. But what it all comes down to, even though you might say, hey, this open range breakout setup, I'm not kind of breakout trader, but I'm more the range trader guy. What it definitely, this is the main reason why I created this document here, is to make sure that you guys really understand that you have to have a trading routine. You have to have a clear set of rules you follow in your trading, and you have to do this over and over and over and over again. And even though that might look here as if the market is about to top out here, I'm not necessarily going short here. So, I mean, I haven't backtested the open range breakout setup, by the way, for the NASDAQ here. But for example, let's come now down to the S&P 500. So I've prepared already everything here, just to give you a short overview. By the way, we just had the market opening. It's 3:30 here, so 1:30 p.m. GMT. So, so first of all, the green line is the lows from yesterday. The red line is the highs from yesterday. The deep blue line is the close from yesterday. And this turquoise line is the first tick now at 1:30 p.m. GMT. So the spot open on Wall Street. And now let's have a look here at, for example, the daily chart. So where are we and what to expect? Well, where are we? Let's say we are clearly in an uptrend, higher highs, higher lows. In fact, I haven't looked it up right now, but I can tell you that we are more than 1 year now away from a 5% corrective move here. So market is really volatile. There's also something which is indicated here by the VIX, for example, being below 10. Some might say, hey, when we broke to new all-time highs here, when we broke above 2,490, isn't that the moment when we are trading in something you usually call the distribution area? Yes, in fact. So what I'm talking about is the following. Just let me give you the chart here. I usually call it the so-called discretionary touch here, but you can see here, if you just imagine that this is the S&P right now, you can see that the market obviously had it here, based on my personal definition, in a red area. It's the so-called distribution area. And the thing is that here, market participants usually start to step back in this market environment from long engagements here, since the risk reward is not that attractive. So usually trend traders, or also those trading the progression here, institutionals usually, they try to build positions here in the so-called accumulation area. They try to trade into the retracement, since from here, first of all, the risk reward is more attractive, but on top of that, it's also the case that here you get the material you need. So just imagine you're a big fund and you're having something like, I don't know, you have an order and you say, hey, I need to buy 100 million worth of S&P 500. So while you know that the market will go here to new highs, and many people will see that, and many people will trade the breakout, and many people will be probably stopped out trying to catch the top here and saying, when the market makes new highs, I'm out, and being stopped out of short position means you're buying here. So many buyers coming in here, you know that even though you might have an advantage of being a big market participant here and having some good relationships with brokers and all that stuff, you will have trouble to find enough sellers for getting your 100 million into the market. So what you have to do then is you have to you have to start buying here and try to anticipate such a break here on the upside. And that's exactly how usually professional traders and institutionals especially here try to act in this case. So we make it very rough here. So don't say, well, I've seen institutionals doing something completely different. It depends on the strategy, but I just like to make the point here that you get the point that it should be self-explaining that buying here when the market breaks to new highs is, for an institutional, a problem. For us as retail traders, it's not a big deal at all, since we are not trading as big as institutionals. and we are somehow flying below the radar, if you want. So we don't have trouble to buy one lot here. We don't have even, I think we don't even have a problem to buy 1 to 10 million here if you have the right broker. So for example, JFD brokers here, they are right now offering, by the way, there's a very attractive product. You can see it on the FX Street website. On top of that, let's just see whether we can find it here. 1 sec. So fxstreet.com. So it should be, I think, around the. Oh, by the way, what I can tell you here, German election, no worries about that. It's a done deal that Angela Merkel will be the next chancellor here. So there will be no volatility at all. Even though I don't recommend to hold big positions here over the weekend and everything, be really aware of that there's election, but don't think there will be any surprise. There won't be any surprises. Let's just have a look here. I'm not sure. Do we have something here? No, unfortunately not. So so this will usually change here. But what I can tell you. What I can tell you definitely is that, for example, in case of JFD, working with all those liquidity providers and really tier 1 liquidity providers, banks, and all that stuff, you won't have a problem here to buy up to 10 million too. And you will probably also face positive slippage here. So it's not unusual to get a better price than the requested one when trading with JFD. I can definitely tell you that, and also for bigger volumes. So I, as a money manager, for example, I'm also managing clients' money here. I never had any big problems to get a bigger position on here. And so nevertheless, and that's what I want to point out here, the thing is, institutions usually plan to buy here and usually start to give their positions here once the market moves up to the so-called distribution area. And the thing now is the following. If you adapt this here to the current picture we have in the S&P, what we can say is that the market obviously is trading in a region of new highs. And we're trading in a region where it's a very low volatile market environment. So I've shown you the VIX here already. So that said, some might argue now, by the way, where's the low here? I think it's 9.3 or something like that. So no, it's 8.84. So we probably will make it here to 8. I mean, why not? Below the 9, yeah, it's horrible, by the way. For breakout traders, this is horrible. And I wouldn't be surprised to have no setup at all in this volatile market environment here. But so let's come back to the current situation in the S&P. So what we can see, or definitely say, is the market is trading in a range or in a region where usually you won't consider long engagements to be really attractive. And there are plenty of reasons, also from a discretionary side, also from a market structure side, and especially here from a distribution area concept. There are several reasons to say, well, probably the market will dip lower from here, especially now with the Fed being more restrictive. You might say, hey, look at the US dollar, probably, and well, not just probably, but also equity markets in the US profited from the US dollar being under pressure here. And for example, being aggressively sold here over the last months. And now, obviously, the market probably is about to top out here against the euro, for example, which could and would mean there are plenty of reasons to expect the S&P finally come down. But now the thing is, again, we are not predicting. We don't want to predict the market, but we only trade our setup. Meaning, it could be that we're trading the short side today, but therefore, we have, for example, to trade below the 15, below the exponential moving average 10 here on a 15-minute time frame. But this is the thing when we trade the short side. If we are now, and right now we are waiting for this open range here to be built, which, by the way, takes another 35 minutes here till this range is finally built in. Then we say, okay, and now based on one here, we identified the advantage, and if we are trading below the EMA 10, then okay, then we are going short. But if we're trading above that, And if we're breaking out of this range here on the upside, well, then we're trading the long side, even though there might be several signals and signs that the market's probably topping out. And we don't have to be we don't have to be nervous about this or something, because 1 second, I'll just show you a picture here. We don't need to be worried, since we know that this approach works. It does. What we can see here is the development in the equity curve. This is the equity curve of the open range breakout back till November 2010 here. And what you can see is that it's going from the left side here on the downside. It goes up to the upper right, and that's usually a clear sign of an uptrend. And then equity is obviously rising by trading this approach based on the input parameters I just presented to you here. And now you can also include, by the way, here, for example, you can also include those numbers here. For example, 1.08 and 0.82 in our formula. For example, we just formulated already here. We know that the payoff ratio, oh, by the way, let's do it that way, is so type this in calculator and you get 1.3 to 1. Okay, and then you can say, okay, well, now I know this ratio, but I also have the hit rate here. You can see the hit rate here, the win rate is 47%. And then you can include this here in the formula. What happened here? Here. You can type this in the formula for the expected value. So it's EV, and you have the average winning trade, 1.3. You multiply this with 47%, and then you just subtract 1. You multiply it with 53% here. And at the end, you'll get nearly 8 cents per euro you risk. So it's this one, and then you multiply it. Yeah, obviously it's by 3. So, and the result is very interesting, since it means it's, first of all, it's bigger 0, so you're making money, which is no big surprise. You can see this here with the chart already. But the thing is, now you have to interpret this number. What does it mean? It means that by trading this approach over and over and over again, you're making on average 8 cents per euro, per US dollar, per British pound, whatever currency you're trading in. You're making on average 8 cents per euro you risk, let's say. That said, let's say you're risking 100 euros. It means on average you make 8 euros per trade. It doesn't matter if it's a winning or a losing trade. And in fact, you're more times on the losing side than you're on the winning side here. It's 47% just the hit rate. But, and this is the thing, you're looking here at a number of trades of 1,347 trades you made with this approach here. And you're doing this over and over and over again, completely ignoring the noise around you. So what I can tell you is it's not just that from time to time you will face a losing trade then in the current market environment and say, hey, you know what? I knew it. The market would top out, and there's plenty of reasons here there were plenty of reasons not to be long here. And now look at this. I mean, is this really necessary? We could have avoided this losing trade here. And you're completely right, yes. But the thing is, again, you're not predicting when trading the markets. Professionals don't predict, but professionals work as a casino does, and they manage their risk and they let their edge play out. And the edge is to just go with the setup. And I tell you the following, there will be plenty of times when you are shorting those highs and the market is just going higher. Just look at what's happening right now in the Dow Jones, for example. I mean, this is the perfect example, I think. If you look at the Dow Jones, who would belong here? Let's say on the 15th September. Would you go long here or here or here? Look at what's happening. The market is just popping higher all the time. Same thing here. So there are streaks right now which seem to be ridiculous, even though those streaks, it doesn't mean that they will end here. And if you're a trend follower, you only have one choice but to trade your system. And then I bet there will be plenty of systems out there just buying every break to new highs and still be profitable here. And they are profitable because they just keep on doing what they do best. Let their edge play out. And the edge in case of a trend following system is follow the trend. That's why it's called a trend following system. And I'm not saying that there are not systems out there like anti-cyclical trading setups and trading against the trend, for example. And I bet those systems are also profitable if you have the right input parameters here, if they are stable, if they're robust, if you have the right risk and money management plan, and if you're mentally stable enough to just trade them through. But I can tell you the following. Right now, those anti-cyclical setups, I bet they won't play out. But also here, it doesn't really matter, since there will be times when the market, rather sooner than later, will top out and then see a sharp drop here, a sharp rise in volatility for whatever reason. And this is exactly the thing. There are plenty of approaches out there, and everyone has to find the style which fits the personality, his personality, her personality best, and just keep it trading through. And don't do this system hopping here and think, okay, I had 5, 6, 7, 8 losing trades a row or something, and now I'm switching systems, since it obviously doesn't work. So you will find series, and I can tell you something. I mean, the system here, for example, where is it, the picture? Well, there are losing streaks. I can tell you, there will be times when you have 6 to 8, 10 trades a row you will losing. Just imagine that. I mean, we're trading nearly every day here with this system, and it's 5 days a week. And now imagine you have 10 losing trades a row. That means 2 weeks of pain and 2 weeks of seeing the system lose over and over and over again. Monday to Friday, weekend, great. You try to relax. All you can think about is your trading system not working, and you start out again on Monday. You can't wait Monday to finally come to trade the market opening. Boom, next losing trade. And this is happening over and over again. And this is where trading psychology and mental stability comes into play. Why it's so important in trading, since to hold on such a system here, since you know what to expect before, because based on a solid backtest here over a long period of time, you might you build confidence in the system, since even though it's not very cool to see that, you know the system still is profitable in the long run. And this is exactly what a casino does. Let's come back to the casino example here. Just imagine one guy coming to the casino and just having a hot hand, let's call it here, in blackjack or in roulette or something like that, and winning hundreds of thousands, probably millions, against the casino. So he will definitely be watched at, and the people will, or the casino managers will say, hey, get this guy out of here. But the thing is, let's just imagine that won't happen. In the long run, he will definitely bring all those millions and hundreds of thousands and millions of euros, dollars, pounds, whatever he made back to the casino, since the casino knows the edge is on our side, and we have a positive expected value, and this guy is just getting lucky. As for example, if you want the market is somehow getting lucky, that sounds ridiculous, since the market's always right and never ever question that. But the thing is that at the end, if you know what you're doing and you're trading a system which you know is profitable here in the long run, you'll have a great chance of making money. But the thing is that you have to build this trading routine first. And the thing is that you have to start to think in expectancy, if you want, and to understand what this formula is about here around the expected value. And even though it might sound really easy, and as the saying is very easy, let your winning trades run and cut your losing trade short. All this is true. But, and this is the thing, you can't imagine how difficult it is to just keep on believing that this formula will play out in the future for you too here. And this is exactly the reason why, and now let's close the big cycle here. That's one of the reasons why I personally believe, and I firmly believe, that this approach here around this open range breakout is such a great approach, since you can adopt it to several markets, and you can easily build a trading routine based on that, because you just can learn with a very simple set of rules. Just take these simple 3 rules here. You can formulate a setup and trade them through all over again, and based on that, become profitable in your trading in the long term. So I just have a look here in the chat box, by the way. One second. If I'm in London, no, I'm not in London. I'm located in Berlin, in Germany. So EURUSD going down. Let's just see. I mean, I don't know. The thing is, let's just have a look here at the EURUSD here. So my personal thinking is, in fact, that I think that it has a good chance to go down, even though. Oh, by the way, let's take this one. I already deleted the setup here, but we are now pushing towards a potential short trigger around 119.30, 119.50, somewhere here. So I'm not even sure if I want to go short here today, but the thing is, somewhere in between here, 1930 to 1950, with a stop above the highs here from yesterday. We have a risk of something like 105 pips maximum. And from here, I'd like to try a short, anticipating a break below 118.30. So in fact, when I trade currencies, that slightly differs. Even though I know that's profitable, I can see this based on my trading journal and all the stats I have here around my trading, that I'm doing something right since it's profitable. But that slightly differs in terms of this purely quantitative approach. So I have some discretionary touches, some more discretionary touches here. So for example, I also look at the sentiment here in the EURUSD. So let's have a look here at some stats. I just hope that the numbers now are updated. Yesterday I had some trouble here on the website. No, not good. Okay, so whatever. So the euro is right now very extended on the upside, and markets are heavily euro long, in fact, not just in the future, but in all other markets too. And here the thing is that with such a sentiment extreme, rather sooner or later, the market will probably top out and see some really strong move here on the downside. On top of that, the ECB compared to the Fed is very, very dovish in their monetary policy here. And so here also from a fundamental perspective, I think the market is about to rather sooner or later see a dip on the downside. And from a technical perspective, we can say that everything below 18 here should be considered bearish. Probably we have to move. Some might say, hey, this is the last relative low here, not this region, but this region, since we have to have close above the former highs here from a market structure perspective. So we have to go below 116 here, 116.50. But all in all, I think the market is probably about to rather sooner or later turn and see a sharper drop, probably down towards 115. And that said, there are plenty of reasons here from this perspective, macroeconomic, technically, but also sentiment based, that euro is probably a good candidate for the short side. But right now, I'm still waiting for a good setup to happen here. So let's just see how the market behaves here. There were plenty of those occasions in the past when probably some might have said, well, look at this. Now the market is about to really dip lower here and then just drifted higher. Just imagine what happened here. Around 1 week ago. What was the reason back then? not even sure. So there was probably one guy. So some rumors around the ECB or something. I'm not sure. It doesn't matter. But the thing is, it's all in all, it's still very choppy. So be really careful when anticipating a toppish structure here and a break below 18, since the market overall is still neutral and to be considered, should be considered very choppy here. And yeah, so that's one of the reasons why I look at this region, but nevertheless, I'm not right now shorting it, but I carefully watch it. So, and now let's have a look here at dollar Japanese yen. There was also, it's one of my favorite pairs, and it was one of my favorite pairs before the Fed yesterday. And I'm not surprised to see this momentum this continued momentum here on the upside. But the thing is that I'm really careful with long engagements here, since we also have to remember that the Japanese yen is a currency which is usually bid in the moments when there's risk aversion coming into the market. And that said, I mean, with the volatility being that low, and somehow still with the feeling that probably we are really extended here on the upside, also in the US equities. There's plenty of reasons to believe that probably either sooner or later there will be at least a small dip here back to those highs. And that's one of the reasons why I don't like to be long dollar Japanese yen here. By the way, I just read something about a divergence on a 4-hour chart. One sec. A divergence on a 4-hour chart. Let's have a look here. So higher highs, obviously. And now let's have a look here at some oscillator. Let's look at the RSI. Yeah, I mean, that's definitely true. So making higher highs here. So from here, a dip seems to be likely. It's obvious based on this. I'd only say that the market is losing momentum here. But nevertheless, we are still bullish as long as we trade above the highs. I'm sorry, the lows from yesterday here. So any pullback to this region around 111 should be considered a long entry instead of a short right now. So be really careful about that, I'd say. Okay, so I've answered all the question, I think. Hey, perfect. Just saw that the webinar here is about to end in around 3 minutes. So not sure if we should keep on talking about the markets here. Just to have a look at how likely it is right now that we get to see a range of 2.0. That's perfect. Okay, so we can already say we get to see a setup today. So, and I can already say that because in the first half an hour of trading, the open range so far is 2,504 on the upside, and the current low of the day here is 2,496. So it's already bigger than 5 points, obviously. As you can see here, it's 7.75 points. And so far, what we can also say is that obviously the market so far is trading below the 10 exponential moving average here. So that said, we know we still have to wait another 15 minutes. So it's just like so far it's just a rough version now of the setup. But I can tell you we'll have a setup here range, which is currently between 2,496.25 and 2,504. We're trading below the 15 EMA. So if we were right now at 2:15 p.m. GMT, still 50 minutes to go from here, but if we were right here, then we trade the short side. The interesting thing is, by the way, my approach also switches back to the long side if the market really pushes back above the exponential moving average here on a 15-minute time frame, 10. So that said, here in this moment, we're going back above this and break on the out of the open range on the upside. And that happened several times, by the way, in the past. Then we're trading the long side, okay? But don't let get too complicated here. That's how I want to finish here. Let's just see next week here, at the next webinar at 2 UK, also 2 p.m. London time, so 1 p.m. GMT. Let's just see if this setup worked out. If we were triggered at all, by the way, it can be that the market builds this open range, but it's not triggering on the down, respectively on the upside. Then, but just let's see whether this plays out here or not. And yeah, so that's it from my end. I hope you enjoyed this webinar. If you have any questions, please feel free to contact me via Twitter. I'll give you here my Twitter. It's at Jens Klatt FX, or you can also send me an email to jklatt@jk-trading.com. And for any information around JFD, also you can shoot me an email or contact JFD directly. And yeah, so that's it. That's it from my end. Hope you enjoyed it, and have a nice day. Happy trading all the time. Watch your stops, and talk to you again then next week on Thursday, or if you want already tomorrow at 9:30 a.m. GMT. Have a look at the YouTube channel here from JFD Brokers. I'm holding a daily morning meeting here. And yeah, so that's it from my end. So have a nice day. See you, and bye-bye.